Welcome back, Val Investors. Welcome to 36 Square Capital, Val Investor channel on YouTube. So one of the companies I wanted to analyze since already a couple of weeks was in fact Bed Bath & Beyond. And I know the brands when I was traveling to the US. I remember their retail shops. Maybe you are aware of what is going on in Bed Bath & Beyond. And basically we are discussing a bankruptcy, and one of the questions I was wondering is in fact if this bankruptcy was predictable by looking at the financial statements. So let's have a look into the financial statements of Bed Bath & Beyond. So the latest news from Bed Bath & Beyond, or at least from April, is that they filed for Chapter 11 protection of the US Bankruptcy Code. And as I said in the introduction, the main questions I wanted to understand is if this bankruptcy was predictable, what were the reasons for the bankruptcy, and if it could have been avoided, but also if as a serious investor, value investor, you would have detected, or we would have detected elements that would have avoided us from investing into Bed Bath & Beyond. I mean, let's also be very clear, there is no disclaimer here. I have never invested into Bed Bath & Beyond, but just I think it's good to practice our eye on the financial statements and try to understand what are the learnings that we can extract from reading the financial statements. So a little bit of history. I mean, Bed Bath & Beyond, for those who would not know the brand, exists since 1971, has been incorporated in Springfield, New Jersey. Went public, so IPO'd in 1992, and as you saw in the previous slide, they filed for Chapter 11 in April 2023. So they are basically, let's say, close to bankruptcy, and they will probably have to sell their assets. And actually, it's something that is already going on. Where if I remember well, I saw yesterday that an investor in Canada has been picking up part of their retail stores in Canada. In terms of brands, I mean, the Bed Bath & Beyond brand is the most known brand, but they had also the Bye Bye Baby brands and other brands like Harmon Face Values and Face Values. And then Decorist, which is apparently, I don't know the brand, an online interior design platform for personalized design services at home. They apparently launched as well 8 new brands in 2021 that you can see here in the slide on the bottom right. Their main operating assets, and most of them were carried in the balance sheet as operating leases, not owned by Bed Bath & Beyond. They had approximately 950 stores, mostly located in the US and Canada. And also they had a joint venture, if I remember well, of 4 stores in Mexico that was also run under the brand name Bed Bath & Beyond. So just to give you a sense of what the company is all about. Something that is interesting, and I actually looked, and you're going to see this in all the 10K reports, into all annual reports that they filed since 2013 to 2023. Actually, the latest 10K report for the fiscal year 2022 just came up a couple of days ago. And you see, in fact, already here, I mean, there are 2 graphs. One is something that they disclosed in 2022 10K report. So you see, of course, that the performance is really not good. It came back after COVID. But the performance, of course, of the share price was really not good. And on the right-hand side, you see an extract from TradingView, which is a site that I do use, where you see when they IPO'd, so the stock price was always like fluctuating between, let's say, 20 something and 40 plus something. Then it went up at a certain moment in time up to 80, and then it came down. I mean, now it's close to 0, in fact, because the company has negative equity. So one of the, when you are in such a situation, how to address, if you want, and I wanted to capture signals, early signals of what has been going on with Bed Bath & Beyond. So basically what I did, as I already mentioned a couple of seconds ago, I took all 10K statements from 2013, 2023. So I looked a decade back. And what I did is what is called an horizontal analysis. So I put like the balance sheet, the income statement, and the cash flow statement into one single Excel file, taking out the main elements of the balance sheet, and then of course looking at cash flow elements and income statement elements. But you know, if you have done my courses, that I always start by analyzing companies by looking at their balance sheet first, because their balance sheet shows what has happened to the company since day one. In fact, at any moment in time, you're going to look at the balance sheet, which is not the case for the income and the cash flow statement. All right. So from there, basically what I was able to see, in fact, that there were three phases that I think are worth mentioning. The phase one, which started to happen in 2013, so for the fiscal year 2012 up to 2018, which is fiscal year 2017, is that already there it was pretty interesting to see, and this continued in 2022, 2023, that the company has been spending more money on share buybacks and even dividends than the amounts of cash that they were collecting from operational cycles, or from operating cash flow and from financing activities. Obviously, I mean, for those who know, normally the investing activity should be in spent, so that normally the investing activity is negative, but the operating cash flow should always be higher, or very often is higher than the investing activity. Hence, the money left is something that potentially can be provided as return to shareholders or to pay off debt. All right, so what's called the free cash flow to the firm. All right, so that's already the first thing. So there, and we will zoom into the bottom part of this horizontal analysis, big picture that you have here from 2013 to 2023. Then there was a second phase that happened for the fiscal years 2015 to 2017. So the reports came out 2016, 2018, where in fact the company started to face revenue declines. And this is pre-COVID, so there was something going on in probably, let's say, in the strategy, in the competitive landscape of Bed Bath & Beyond, where the revenues actually were, I mean, the company was unable to keep the growth of the previous years, and the growth was nearly flat at that moment in time. All right. And then the third phase, which happened, of course, COVID hit all brick and mortar, let's say, retailers, and Bed Bath & Beyond is a brick and mortar retailer. So I'm not sure how much they do on e-commerce, but I understood by reading a couple of reports that they missed a little bit going into the e-commerce part. So in 2019 up till now, in fact, the company has been posting losses. So not only the revenue decline continued, and actually the revenue decline became negative, but at the same time, in fact, of course, and we're going to see this when we will have a conversation on the fixed cost, I mean, the gross margin was unable to cover for the fixed cost. So basically they were actually having losses for the last 5 years. And we're going to be discussing this later on. So let's zoom in a little bit into phase one. So 2013, 2018. And what is, I would say, remarkable or interesting here, let's start with the bullet point number 1 that you see on the right-hand side in the bottom. So this is the extract of the cash flow statement. So there, in fact, what we can already see when you look at the operating cash flow is positive in 2013 by 1.2 billion. On March 1st, 2014, when they reported of 1.4 billion. So they had an operating cash flow. So the operating assets were generating profit. So that's great. We can always discuss a percentage, but at least they were generating cash. And then, of course, there was some kind of investing activity. So as said earlier, so in 2013, I mean, they spent like 600 million on investing activities, and in 2014 they spent 363 million on investing activities. So, I mean, if you do the math between the two, it means that for the year 2013, that is covering fiscal year 2022, they made, I mean, there was kind of $500 million available for either paying off debt. At that time, they did not have any debt, from what I recall, or potentially providing return to shareholders. In 2014, I mean, rough cut, there was 1 billion left that they could, again, there was no debt at that moment in time, but that they could provide a return to shareholders. What is already remarkable at that moment in time, so keep those figures in mind, $500 million for 2013, 1 billion for 2014. The company spent on share buybacks $1 billion in 2013. That's $500 million above the cash that they were able to keep after the operating and investing cash flow. And they spent 1.3 billion on share repurchases, while they had only $1 billion actually of cash available. So here you see that over those 2 years, they basically destroyed already 800 million. So $500 million in 2013 and 300 million in 2014. And then what is worse, in fact, in 2015 is that in 2015, so we see that the operating cash flow, you see this on bullet point number 2, the operating cash flow is going down a little bit to 1.1 billion. Okay, but it's still positive. So, I mean, there's maybe some kind of cycle to this business, but okay, I mean, it's more or less in the area of the previous years. The investing activity was actually a little bit positive, so they did not invest too much. What was more, let's say, interesting, and I will start with bullet point number 4. So if you make the math between the operating cash flow and the investing cash flow for 2015, so for the fiscal year 2014, so a rough cut, they had 1.2 billion of cash available for either paying off debt and or providing either cash dividend or some kind of return to shareholders, maybe under the form of share buybacks. So, and if you look at bullet point number 4, so I just said 1.2 billion available, they spent 2.2 billion for share buybacks. So they overspent again by 1 billion. So remember that in 2013 they overspent $500 million, in 2014 they overspent 300 million, and in 2015 they overspent by 1 billion. So they are destroying cash, in fact. And what is interesting, of course, I mean, when the company runs out of cash, the company has one possibility, is potentially to go either to the debt holders or raise fresh money from debt holders and or raise fresh money from shareholders. What they did, and this is documented under bullet point number 3, they raised $1.5 billion US of debt. And I mean, this is, I will not say it's criminal, I'm not a judge here, but I mean, this doesn't make sense. So the company was running out of cash. The board of directors has been destroying and has been overspending and doing excessive share buybacks already in 2013, then in 2014, and in 2015 they spent 2.2 billion US dollars while they don't have the cash available. And I mean, if you look at the beginning of the period 2015, they had 366 million of cash in the bank. So in order to please shareholders, they raised debt, but they still spent much more, 2.2 billion, to do share buybacks. I mean, this cannot be. This doesn't make sense at all. So this was already like, this does not show good governance. This does not show fiduciary duty by the board of directors. And we'll come to that later on. So, and I have been just now extracting the cash flow statement for 13, 14, and 15. So the overspend that they have been doing, so I've put here the figures in the red frame on the bottom, on the bullet point number 1. So rough cut, $500 million 2013 of overspend in terms of cash, 2014 rough cut, 300 million of overspend, and 2015 $1 billion of overspend. But they continued doing this in 2016 and 2017 and 2018. They spent more money, more cash than actually they were able to collect as free cash flow to the firm. So this was really not making sense. And on top of that, and this is on the right-hand side, in 2022, they continued, in fact, and they are actually reporting about it in one of their latest financial reports, where I think that's the 2022 report, if I'm not mistaken, where they are, I will not say that they are bragging, but they are mentioning that they have recommenced the payment of this either share repurchases or dividends coming back of COVID. So they started this again in October, so this practice in October 2020, and then again in January 2021. So, and they are, let's say, kind of proud to say that we are here basically to please our shareholders, and we have spent like 950 million up to February 26, 2022 on doing repurchases on a 3-year plan. So they stopped doing share repurchases during COVID, but then it came back and they started again doing share buybacks. All right, and in one of the latest reports, what struck me is that they really, I mean, the CEO and the chairwoman of the board of directors, they at least are mentioning that they use a term that they are creating value for shareholders. I mean, yes, short term, they're creating value for shareholders because when doing share buybacks, obviously, I mean, as the amount of outstanding shares is reduced, normally the share price should go up. So they are, I mean, it's a way of mechanically providing capital gains until the moment, of course, the holder of the shares is selling its shares. But normally the intention of share buybacks, and also from a tax perspective, why companies have been doing more share buybacks over the last 2 decades, because the tax treatment is a little bit more favorable than cash dividends. Anyhow, for me, the problem here is that they are mentioning that they are creating value for shareholders. But again, in 2022, coming back from COVID, they started again doing share buybacks, and they have been spending more versus what the free cash flow to the firm. So the sum of the operating cash flow adjusted to depreciation and amortization, and adjusted as well to changes in working capital plus investing cash flow were offering. So they were again destroying cash. So they were suffocating. So they were extracting the cash that was there from the company. So that's for phase one. So that does not show to me right, let's say, governance from top management, senior management, and the board of directors. Phase two. So phase two, if you remember a couple of minutes ago, I mentioned that in phase two, starting 2016, 2018, you see it here on the top right, on the bullet point number 1. So here the net earnings, that's basically what is the summary of the income statement, but I'm looking at the cash flow statement here. Because remember that there's a difference between accrual accounting and cash accounting, but nonetheless the first line in the cash flow statement is of course the, let's say, the income, the net income, but from an accrual accounting perspective. So what we see here is that the amount of profit is going down from 2016 to 2018, so from 841 million to 685 to 424. And what is interesting is that their fixed costs, in fact, have not been reduced. So the amount of fixed costs, in fact, has, stays more or less at a level of 3.2 billion. In fact, it even grew to 3.7 billion. So basically, having a decrease in profits, and at the same time having the fixed cost of the company not under control. So the fixed costs actually increased by $500 million over that period of time, over those 3 years. Well, of course, that's very problematic. So at a certain moment in time, you're gonna end up, in fact, very probably either running out of cash or at a certain moment in time making losses, because your cost basis is not, your cost baseline is in fact not adjusted to the revenues and the gross margin that you're making on your operational assets. All right, and nonetheless, despite those signals, they continue to do share buybacks. You can see it on the frame number 2. So they continue to do share buybacks. In 2016 they spent $1 billion, in 2017 547, and 2018 they still spent 252 million on share buybacks. So of course, that's again, this is again reconfirming that the board of directors and senior management, in my opinion, were not taking the right steps, and they were just focusing on providing return to shareholders short-term, but destroying long-term value for shareholders. Then we come to phase 3. Okay, I understand phase 3, there was COVID. All the brick and mortar retailers, they were hit by the lockdowns. I fully understand that. But when it came back, so after COVID, 2021, 2022, and 2023, and here is an extract from the latest 10K report, which covers the fiscal years 2020, 2021, and 2022. And it actually came out just a couple of days ago, because they had announced that they were late on filing the annual report for the fiscal year 2022. So it just came out recently. And what is interesting, when you can look at it at bullet point number 1 in the red frame, is that in 2021, 2022, and we already saw this in 19 and 20, but on 19 and 20, I may understand it because it was COVID related. And a lot of companies had negative earnings during that period of time. But here at 21, 22, they continued to write losses. And in 2023, it's a huge loss. Just the operating loss is like 2.7 billion, and when you look at the bottom there, the net com attributable to the common shareholders of Bed Bath & Beyond is like 3.5 billion of losses. That's just huge. So we need to understand what has been going on. But before doing that, one of the things that, for those who did my course on value investing, I always tend to look into as well, because very often, when you have this typical corporate growth curves, what is called the S curve of corporate growth, I mean, even at the top of the growth, I mean, the financial metrics look good. But before the decline starts, I mean, you already have other metrics which are non-financial metrics that you can see that customers will probably not stay with you, even though management believes that and is, let's say, making it a beautiful story, that the financial metrics are fantastic, etc., etc. And one of the elements I like to look into is something that also I learned from Phil Fisher, which is called the scuttlebutt method, where in fact is looking at what are customers and employees actually saying. So I cannot cover suppliers, and competitors would require a really longer strategic analysis. But what we can see, and I looked into the Comparably website, if it is the customer net promoter score, for those who are knowledgeable with that, I mean, that's the likeliness of customers either to stay or to continue to buy the brand or to promote the brand. And the customer net promoter score is really, really bad. I mean, I was able to see it since June 2022 until now. I mean, it's hugely negative. So the brand is not loved. Obviously, when the brand is not loved, people will switch to other brands, right? That does make sense. So just looking back 1 year, we could already see that, and I would expect that the trend was already earlier visible on this. From an employee perspective, I mean, the CEO has a very bad score since 1 year. I mean, I think they have now changed the CEO, but Mark Tritton has a F score, so 51 out of 100. I even think that Elon Musk in the Twitter company has 70 plus in terms of scoring. So, and you can see it in the Comparably side, they are mentioning that it's really the bottom 5 of more than 1,300 companies that are of similar size on Comparably. So, I mean, again, this shows that the company is, in my opinion, not well run when you have a lot of negative employee sentiment, a lot of negative customer sentiment. So coming back now to phase 3, it's not just about the overall huge loss that they did over those 3 years, and more specifically the huge loss that they did in the fiscal year 2022 that was now reported in the latest 10K report. But what is more interesting as well to analyze, and when I looked into that, how is it possible that from, let's say, smaller losses of 150 million, 559 million, they end up doing for the fiscal year 2022 a 3.5 billion loss? And I found, or I caught a couple of elements that struck me. The first one is bullet point number 2 is this impairment, and I'm going to show you what this is all about. And then bullet point number 3 is loss on preferred stock warrants and derivative liabilities. So they actually took a hit of 1.3 billion on goodwill and other impairments. And they are mentioning it. Of course, they have to disclose in the latest 10K report, where they have probably reassessed the fair valuation of some assets, long-lived assets that they have. And they are taking a hit on those assets of 1.28 billion, in fact. So they are writing, they are taking an impairment charge. So for those who know a little bit accounting, if you have assets in your balance sheet, like inventory, like maybe buildings, those kind of things, you have to reassess every year, potentially even goodwill, you have to reassess with a fair valuation how it is reported in the balance sheet. So here, in fact, they did the yearly impairment testing, and they are actually writing down 1.3 billion, in fact, on this. I mean, let's be very transparent. This is a non-cash write-down, but it means that they have probably been inflating, or at least the previous year's financial reports were overestimated on those assets. This is what I mean. So it's a non-cash impact, nonetheless, just to be precise. And then the loss on preferred stock warrants and derivative liabilities. They're giving an explanation. I need to be fair. I'm not the specialist, and I did not understand what they mean by that the offering was not an orderly transaction. But for me, I mean, typically when I look at loss on preferred stock warrants, I mean, if the company is making loss, is that they have promised stock warrants at a certain price, and if the stock goes down, they have to cover the difference. So this is actually a loss for the company. Right. What was interesting, I mean, I'm looking now specifically, something I forgot to say, on the loss on preferred stock warrants, that was a 639 million loss, in fact. So that's also a lot of money. So you see, like, basically the 2.something billion, I mean, there's 2 billion that are coming actually here from those two elements. But I was like, wait a second. I mean, this impairment thing, that's something that has to be done on an annual basis. So I went into previous reports, and I was like, let me have a look at the independent auditor's report. And so what I found was pretty interesting, because for the years, so 2021, which is covering fiscal year 2020, for in the report that was published 2022, which is covering fiscal year 2021, and in the latest report of 2023 that is covering fiscal year 2022, it's interesting to see that in 2021, 2022, there was each time by the independent statutory auditor, which is KPMG since 1992, we're going to discuss it in the next slide, that in fact the critical audit matter related to the assessment of those store-level long-lived assets and their fair valuation was mentioned. And I mean, this is typical in the sense that auditors, when they have doubts, they're going to report the critical audit matter. That does not mean that it becomes a qualified opinion. So the auditors were fine with the financial statements in those years. But they are mentioning this as a critical audit matter in order to say, well, we are disclosing this and we rely on management's judgment about how they are doing the fair valuation of those long-lived assets. And what is interesting to see is that, of course, in 2023, the tone on the critical audit matter has changed, and it's being said that they changed the method on how to do the valuation of those long-lived assets, and now suddenly they have to write off and to take an impairment charge of nearly 1.3 billion. I mean, when you have, I'm just going to share my opinion, when you have such a matter that is already listed as critical audit matter in 2022, 2021, and management is not looking into it, I believe, I mean, I will not say here that the auditor should have been more pushy. Yes, the auditor could have been more pushy, but now here, seeing 2023, that there was really an impairment charge of 1.3 billion, I believe that clearly management and a little bit the auditor is responsible for the situation we're having now. It's true, it's a non-cash item, I agree on that, but nonetheless, it means that very probably the balance sheet was already overstated over the previous years because the critical audit matter was listed. Right, so maybe instead of doing 100 plus million of losses and 500 something of million of losses in the previous year, well, maybe already there they should have taken an impairment charge for the previous years, knowing that the critical audit matter was listed, in fact. So I believe that for sure the management, they did not do their right work here. So, all right, speaking about the auditor, as I said, it's KPMG. So, I mean, they had, and I was looking at 2022 report that was covering fiscal 21. They expressed an unqualified opinion, so they were okay with the figures and with the controls in place to build up the figures. And in 2023, what was interesting to see is that they were mentioning for the first time in their report something related to the going concern. And I mean, just to that everybody understands what is going concern, I mean, it's an accounting principle that companies normally, when they report their financial statements, they are done under the assumption that the operations will continue, that there is no now big disruption to their operations. So this is called the going concern assumption. And so the previous year, they did not mention anything. They just expressed an unqualified opinion. And now, with a huge loss of $3.5 billion US dollars for the fiscal year 2022, that has now been reported and has been late reported in 2023, now the auditors come up with a note under bullet point number 1, what you see here, which is where they are mentioning going concern, where they're actually saying, as discussed in Note 2 to the consolidated financial statements, the company has suffered recurring losses from operations and negative cash flows from operations that raise substantial doubts about the ability of the company to continue as a going concern. So, and I'm saying, okay, wait a second. Why are they now the auditors are now doing this? Because typically an auditor could potentially already raise a comment about going concern, or could have raised it already last year. So I looked back into the balance sheet, and this is what I'm showing here, and I saw, so here we are looking at the 2021-2022 report, not the 2023. And I'm showing you here in the frame, in the red frame under bullet point number 1, that in fact the company's equity went down in 2021 from 1.2 billion to 174 million. So the company already last year was close to an equity of 0 or even negative equity. I mean, when the company has negative equity, it means that the book value of the company, I mean, the company is worth 0, right? Or even, I mean, it's even negative then. And I was like, why? And you see it on the left-hand side, I extracted the report from the financial auditor for 2022. And you see that indeed they did not mention anything. If you compare to the previous slide, in the 2023 report, they mentioned after the opinion on the consolidated financial statements, they provided a chapter making a comment about the going concern, because obviously the going concern, or let's say, no, not the going concern, but the equity now is negative in 2023 because the company has destroyed so much wealth, in fact, between 2022 and 2023 with a 3.5 billion loss. So the equity has turned negative, in fact. But I would say here, I believe that the auditors of KPMG, they could have already made a comment in the 2022 report about maybe that they had some doubts about the going concern, because, I mean, the proof is there. The equity went down from 1.2 billion to 174 million. So already last year, the company was at an equity or book value that was very close to 0. So I believe that here the auditors should have raised also, let's say, some concerns and provided a comment after the opinion on the consolidated financial statements. So all in all, if we summarize here, I believe that there was a clear failure by the board of directors and management. So you have seen those 3 phases. Spent too much cash on share buybacks. They did not react on their fixed costs when the revenues were flat, and then after the revenues have been decreasing, and that was a total failure what they were doing there. And they should have. I clearly see that the board of directors has not been paying attention to long-term shareholder value, but they were just attentive to short-term shareholder value. So I believe that there is a clear liability of the board of directors and even the majority shareholders on allowing the board of directors and senior management to allow those excessive share buybacks and paying out dividends. Not even mentioning that they raised 1.5 billion already in 2013, covering the fiscal year 2012. For just being able to have enough cash to do a 2.2 billion share buyback. That cannot be, that you raise debt to give some return to your shareholders. And I believe, and again, I'm not a judge here, I leave this to the judges, or maybe the liquidators that are in charge of the liquidation of Bed Bath & Beyond. But I do believe that KPMG should have already at least made a mention about the going concerns that they would have had already last year, not just this year. So and again, I mean, also on the critical audit matter that was correctly raised by KPMG, but has not been addressed by management. Therefore, sure, again, management has failed on really tackling this. And now suddenly they have to come out of the woods and they have to write down more than 2 billion, or was it 1.3 billion, 1.3 billion of impairment charge on long-lived assets. What is interesting as well, because when I saw this, I mean, here I do see a clear failure by the board of directors and senior management. It was interesting, and again, this is why serious investors, they don't look at curves and graphs to take investment decisions. They read the financial reports, and this is what I learned from Warren Buffett and Charlie Munger as well. I mean, and not only when, I mean, reading financial reports is not just looking at item 8 of the 10K report and looking at the consolidated financial statements, but it's also being curious and interested about other items. And I'm extracting here the essence, which is item 3, where the company has to report legal proceedings. And if I take a company that I'm currently owning, which is 3M, they are providing, of course, they are documenting the current legal proceedings that is going on with claimants related to their ear protection products. And what is interesting in the item 3 legal proceedings, coming back to Bed Bath & Beyond, that I was interested to see or it was interesting to see that they were facing class actions against Bed Bath & Beyond, and more specifically against some officers and directors of the company, with the following allegations. So there were allegations that were reported in the 10K reports about false or misleading financial information, breach of fiduciary duty, unjust enrichment, and waste of corporate assets. I mean, when I saw this, I was like, yeah, so kind of my conclusion is pretty aligned. And if I would have been a shareholder of Bed Bath & Beyond, well, maybe or very probably would have participated to this class action, because indeed, I mean, here management and board of directors, they did not do their work. And what is interesting to see as well, I've put you the URL. I mean, one of the most, let's say, known class actions, I even think that the various class actions, they came together. I don't remember now the details. Is this Vitiello and Bed Bath & Beyond's class action, that they found a settlement for $7 million in cash, and that the settlement has been approved by the court. And I believe that the payment of the settlement has started in January 2023, so 23rd of January 2023 it started. So so now the last questions before wrapping up here is: a serious investor, a value investor, should we have had the opportunity to detect what was going on and potentially staying away from Bed Bath & Beyond? Well, I would say that, well, first of all, I mean, Bed Bath & Beyond, I mean, at least for the last year, has had negative NPS and employee net promoter scores. But for sure, already in 2013, we saw excessive share buybacks. That should have been a red flag for serious investor. And they continued doing this and raising in 2015 $1.5 billion for doing, again, an excessive share buyback. I mean, a serious investor would not have invested into it. At least would have questioned, what is management and board of directors doing? Then the period, the second phase, where earnings became flat, and then suddenly after and even before the COVID already, we saw that they were not having the fixed costs under control. So what would you expect in, something else as negative earnings? No, so negative ROIC, negative earnings. And still they continued after that to do huge share buybacks, I mean, beyond their cash availabilities. And then, of course, a serious investor that reads, and I know it's a lot of work, but a serious investor that reads the financial report of the company, but sorry, that's why those financial reports are there. And I'm thankful to the SEC that the companies are obliged to disclose a lot of things. Well, the item 3 legal proceedings, I mean, that was again an interesting hint already a couple of years ago that something is going on. I mean, the company is facing class actions from its shareholders against officers. So all the signals converge into bad management, into bad governance by the board of directors and senior management. All right, they're going to wrap up here. If you are interested in my courses, I redirect you to learn.36squarecapital.com, or you can go on other educational platforms, and there you will find all the courses as I try to share my, let's say, my experience, at least in full transparency, with you guys, and I hope that this video was useful for you. So thanks for tuning in, and as said, do not forget to subscribe to my YouTube channel, and if you're interested, if you find those videos interesting, and also hit the notification bell. Thanks, and talk to you very soon.